All right, everybody, welcome back to the Cash Flow Chronicles, September 16th, 2025. It has been quite a minute. Actually, I was looking back, and obviously we have the ticker tape that runs at the bottom of the screen. And man, have prices moved since we have last checked in, Mr. Patel. Google actually is probably the star of everything. Since we last checked in, I was actually looking at Google, and we could pull it up on the screen. Actually, I might as well while I'm on it. But last time we checked in was like the late end of June, early July, and Google was like trading at just below $180. And now we are trading north of $250. So obviously, Mr. Patel and I were touting about Google and always trying to say how undervalued it is. And of course, now here we are, $80 later on Google. So interesting. Mr. Patel, how are things? How was your summer? You've been taking a lot of vacation, and glad to have you back. Excited for season 3. You're on mute, man. It's amateur hour over here.
I know it's me. I haven't been streaming for like a couple of months, and all of a sudden, like nothing worked. So like literally 2 seconds, I had to figure out first how to get back onto the streaming thing, and now we're back, so it's good. But yeah, it's just been that long. I had to replace the batteries on my sound capture device, and then it was quick. Summer was good. I turned 40 this year. It was a great experience. I think I'm going through a midlife crisis. I told my wife to be on a Mazda Miata watch. So I said to her, if you randomly see a Mazda Miata parked in the driveway, just know that's my way of crying for help, you know? So yeah.
I mean, I hope it's better than a Mazda Miata, man. I think you make a little bit better than Mazda Miata money, but that's just me.
Nah, you know what it is? I just want like a little sports car, you know, but like I said, it's not practical, so I probably wouldn't get it. But yeah, it's like,
Yeah, man, it's, you've been doing really well. And I'm sure we'll talk a little bit about that with respect to how the markets have been behaving. And you've had a lot of wins over the summer. And so it's been fun. I'm sure we'll get into that a good bit. So let's just do a top off as we always do. And then I have a little bit of an intro video, which unfortunately I somehow destroyed already, but luckily I uploaded it before I destroyed it. September 16, 2025, as always, contemplate becoming a member or subscribe. Subscribing is free. It allows you to participate in the chat completely free. Apple back up to $238. Amazon, $234. Dutch Bros back below $60. Google above $250. Palantir above $170. Rocket Lab was $32 last time we checked in. Now it is above $47. SPY was at 608 last time we checked in. It is now 660, almost a 10% uplift. The Qs, 591. Bitcoin above 116,000. Oil still below $65 a barrel at WTI. And Henry Hub natural gas below $3.20. Ms. Patel, I'll share this one. It's not as good. I don't think it's as good as season 2. I think I got to work on this one, but we'll give it a go.
That's my quant.
Your what?
My quantitative.
You show me a pay stub for $72,000 on it, I quit my job right now and I work for you.
Be first, be smarter, or cheat.
I'm not fucking leaving.
Sell it all today.
Or look at it say, it's beautiful.
Welcome to the fucking show.
All right, so we got some work to do.
I like it.
I
like it. It was good. Yeah. I like it.
Unfortunately, I accidentally saved over it somehow. Like I was actually going to add an intro music at the end, and somehow I screwed it up somehow. Unfortunately, so
no, I liked it. It was good, man. I mean, you put a little bit of background music on it, and it's perfect, dude. It's perfect.
Yeah, I might have to tweak it around, and luckily I have a rule book at least. Or at least a guideline to start off with. So I have all the videos and stuff downloaded, so at least I can replicate it. So very good. Where do you want to start, man? It's interesting. Appreciate the 187 people hanging out with us already. 194 actually just jumped up on Cash Flow Chronicles. Mr. Patel, we already have over 350 or so people that have clicked on X for you. We got some people clicking on Twitch for me, some people on Kick as well. So interesting. We're already back in the groove of things. Appreciate everybody stopping by already. First episode back, not even 5 minutes into it. So where do you want to start, man? There's a lot we can go down. We could talk about the upcoming FOMC meeting tomorrow and what's going to happen with that. We could talk about the moves we made over the summer. In the background, I could pull up our portfolio. What do you want to do? What do you want to do?
I think the first thing, let's kind of just go over in terms of brokerages. We might be moving over our brokerage services over to Webull. Now, there's a couple of reasons why we're going to do that. Number one, if you've never done this as an investor, you kind of it's something that I would highly recommend you do. Not specifically move to Webull, but dog food products. Now, what does that mean? That means that sometimes something new comes out. Webull is not new by any means, but it's something that's new for me and for Matt. And I said to Matt, let's try to use them. I tried using them in June because whenever Amit streams, I feel like the quality of his stream is so much better when he uses Webull rather than Legend. I mean, he's got brand loyalty to Robinhood because he's an investor there, but in terms of like just utilizing some of the stuff to navigate, he uses Webull. So I was like, you know what? Let me try it out, see how it is. And one of the things I realized is that it's actually a really good platform for charting and everything else. And, what you guys are seeing right now is Matt's screen. I'm going to show you guys my screen in just a bit. I've customized a few things, and because of that customizations, it's sort of really helped me out as an investor. Now, my primary brokerages, of course, are Robinhood and Fidelity. I did recently move over my individual account over to Robinhood because they were just giving like a crazy match. And I was just like, well, I don't typically use a lot of fixed income stuff and mutual funds in my normal trading environment. So I don't necessarily need, some of the services that Fidelity has. So I moved that money over to Robinhood. I got a nice little bonus for that. And then my Fidelity does still have all my like tax advantage accounts, because the one limitation, and this is something that I actually, what's with that girl just randomly showing up? What's going on, Maddie? What is that? Is that your background?
Yeah, it's Kendall Jenner.
It's Kendall Jenner. Okay.
Yeah. Right.
So for my IRA and stuff, and this is something that when I went to Hood Summit, I actually spoke to some of their product guys. I said, listen, your platform is great for equities, options, and futures, but the one thing that you guys are missing out on is that you don't have certain preferred equities that right now in this next coming market is going to be very important. So if you guys know on my Discord and even our portfolio, we discussed the Brookfield preferreds, so we still have those have like a nice yield on them. And the thing is, if you, from an investing standpoint, we'll go over the entire thesis in one of the episodes, later on, because there really is a very strong thesis behind it. But if you're looking to create a cash flowing kind of situation for yourself, where you've done really well in the markets and you kind of want to take some of that money, put it into more fixed income stuff, that's typically what you want to do. You want to look at for all alternative asset types that yield you a fixed return. Now, let's say you don't want to do Brookfield and there's tons of other preferreds out there. One day, I think we can even have Steven on. The milkman himself is probably one of the best fixed income investors. I don't know if people know that. I'm just going to call him the milkman. The milkman, Steven Fiorello, man.
Because he always delivers. No, I'm just kidding.
Well, not in our ETF side. He's been consistently underperforming. I thank Steven, because the only reason why I am not at the bottom is because Steven is performing lower than me. But that's because if you notice like the risk level of all the ETF people, you're at the top. You have a lot of small caps. Steven's all the way at the bottom because he's got his speculative fair share too, but a lot of the stuff he has is value. And I have a crazy amount of large caps that are kind of I wouldn't say crazy low, but they're just not performing as much as the small caps. But man, your portfolio is just steaming, just killing it. But yeah, let me go back to what I was like. So we're trying out Webull. Like I said, it's got a pretty good charting platform, and from a streaming perspective, it's really good. So we're going to show off some of the features that it has. And, if you guys want to try Webull, we have an affiliate link that we will, put out there. If you could, if you want to throw some money at it, by all means, it's at the, is it in the comment section? I don't know.
Yeah. So we signed up for the social media content one. So we applied for that tonight. But in the meantime, I've never really done a affiliate one. So if you guys want, there's a temporary one down below. That's you guys can set up. I think you can get up to 4% match. So if you move over, I think the minimum is 3% something right now. That's currently the promotion. So I like Chris said, it's going to be something where I'm learning as well. And a lot of people like to use it for options. So I don't really know. I like to use Robinhood for my options, but I'm curious if this works out well. It could be an opportunity because I've started to feed in. I'm trying to restart a small portfolio of just adding like $1,200 a month. Now, of course, I have like my 401k and stuff like that. But yeah, like if that's the case, then Chris said, we might move our YouTube portfolio over to this, and then also I might move over my individual portfolio. Not individual, my total more individual portfolio, but I might restart from scratch again some of the feeds that I do on a monthly basis, like my monthly buys on like Rocket Lab, Palantir, stuff like that. So
yeah. What's interesting is when I was at Robinhood Summit, and I wish you were there, man, you would have enjoyed it. I got to meet a lot of great people. Like, dude, the amount of, first of all, Amit is a goddamn rock star. Like, the one thing I hate, I wouldn't say hate it, but every time we walk somewhere, anywhere we needed to go, he would be swamped by people. And Amit's such a nice guy. He would never just be like, hey, sorry, I have to go. He would meaningfully like try to have like a conversation. Right. And so I was like third wheeling it the entire time. And I'm like, come on, man, we got to kind of go to this dinner. Like, I'm kind of hungry, So, but yeah, it was fun, man. Just the meeting a lot of you guys. It was pretty surreal. And I got to meet some really, really wealthy people that have a lot of money invested in the market. And let me tell you something that shocked me. You would think that with that kind of money, people were, they go to like Morgan Stanley, they go to Goldman for investing advice and everything else. They're actually reaching out to retail shareholders and saying, what is hot right now? Can you believe that? Someone with managing multi-million dollars, they're just like, what's the thing to look for right now? Because they're not nearly in the, what's the word? Like, they're not nearly in the know about what's like trending. And so there are, of course, like Wall Street Bets trackers and all these other things. But I feel like sometimes retail has like the pulse of the market. And it doesn't necessarily mean that like, the retail is going to get everything right at the, all the time. But they've gotten enough right to the point where the big guys are actually following at least in the direction and saying, look, if there's enough retail interest in a specific area, it might be a good idea to opportunistically buy, even if it's a small part of their portfolio, so that this way they have that exposure, So it's something that Chris Camillo does more and more. If you guys know, Chris Camillo does something called social arb, where he looks at social media and like trends and then invests based on those trends. And Chris Camillo has done extremely well. And I in the past was kind of like a little bit hesitant on doing stuff like that. But over time, I'm actually understanding that, hey, you know what? Dedicating maybe like a 10% of the portfolio to doing a little bit more social arb is actually not a bad idea.
Yeah. So just echoing a lot of what you said, man, I had the fortunate opportunity to hang out with Amit in Miami. And then I had another obligation right after that to go to Rocket Lab. And then I was fortunate to have another obligation. I say obligation is a bad thing. Obligation is a good thing, but another opportunity, I should rather say, to go to Palantir this past week. And so unfortunately, I had to pick and choose, and I was invited to the Robinhood thing, as were a lot of people, right? But, unfortunately, I couldn't make it to that one. Unfortunately, I still have a day job, or fortunately, I still love what I do. And so I don't have unlimited vacation, so otherwise, I would have been gladly met up with a lot of great people. As you guys saw, there was a lot of great photos and a lot of people that were there, and so but yes, I unfortunately couldn't make it, but was able to hang out with Doug in Miami. So Doug, appreciate the 5 members, man. Appreciate you. And Doug and I had a lot of great heart-to-hearts over there in Miami. And speaking of Miami, yeah, I had my own great few conversations and interactions with Amit, and his meetup was absolutely phenomenal. And it's actually part of the reason why I actually want to do more of these streams with absolutely no advertisements in the middle of them. I think the thing that I got most out of Miami, and the thing that I heard most out of meeting so many of you guys, was, first and foremost, I was very surprised that people even cared about seeing me at all, which I thought was pretty interesting. I mean, I was assuming everyone would have just crowded around Amit and wanted to have conversation with him. So the fact that anybody wanted to come over and take pictures with me was absolutely crazy. I didn't expect that at all. So I appreciate you guys. And that was a very, very crazy experience that I was not expecting. But the second thing that I was most surprised about was how much and you guys love Cash Flow Chronicles, and how upset you guys were, and some of you guys, I guess, just didn't have the opportunity to see the last episode from season 2. You're like, what the hell happened? Did you and Chris get in a fight? What's going on? And man, am I inspired. I was literally looking, not only am I inspired by what you guys were saying at the Miami meetup, with what's gotten you in terms of being able to make great money with Chris, or getting into Rocket Lab, or some of these other great opportunities that we've been able to find over the past few months or years working together on Cash Flow Chronicles. But the what was the verbiage I was going to say? The last 5 episodes that we did, I went back and looked, and each of them have over 4,000 views. And so to me, it's been very awesome to see every couple days when Chris and I were doing the last few episodes in season 2, to see that, 2,000, 2,500 people were watching it, within a few days after we would go to the next episode. And we were keeping track of it, and the numbers were looking phenomenal. And so, but Chris and I were burning out. We went to Mexico, and we had our opportunity to kind of catch up. And Chris knows I'm trying to take care of my health a little bit. Chris is taking care of his health a little bit. And, we both just need a little bit of vacation time to kind of heal up. And, but all in all, like, to come back and actually look, it's been a while since I've looked at the actual channel and the videos, and man, to see each of those videos over 4,000 views, it just goes to show the testament of what we're doing here. And so to give back to you guys, I think it's a no-brainer that no midstream advertisements, so that might mean that you see one when you click on the video to initially start it. But hopefully, if you guys see a midstream ad, let me know. My hope is to try to figure out a way to not do that. Now, of course, the replays after the fact, after the stream, will probably have to be monetized. I'm not exactly sure how that works, but the hope is to, if we got so many people to come up to me, and probably so many people to come up to Chris as well in Vegas, and talk about how much Cash Flow Chronicles meant to them, the least I can do is give you guys better, uninterrupted, advertisement-free sort of opportunity to continue to learn. And not only that, but the hope is to get the word out there to help other people. The fact that so many of you came up to me and were so generous and sharing that with me, to show how much love and how much appreciation you gave to Cash Flow Chronicles, and how much you've learned, that just makes me feel like I need to stop being greedy. $1 here, $1 there, fuck that. What's more important is to worry about getting this stream out to somebody who really needs it. And exactly what Chris talked about, seeing what retail is doing, seeing what other people are doing, and at the end of the day, really help people up the learning curve, which has always been my goal and purpose. Ever since I really started getting traction on YouTube, 5, 6, 7 years ago. Originally it was to document my goals and if I ever got hit by a bus, which is still possible. But I started making a little bit of money, and started investing, and my thought process as well was, if I ever get hit by a bus, my family could look back at my videos and be like, what the hell was Matt doing with his money? But then obviously you guys started watching, and it's been an absolute blast, and has led me to meet people like Chris, and has led me to go to Palantir, led me to go to Rocket Lab, and meet those people. And it's just been an absolute blast. So the absolute least we can do is hopefully make these streams, the middle of them, advertisement free. So, Mr. Patel, sorry I went on a big monologue there, but
No, it's all right, man. We'll one of the things we'll definitely work on like this season is just make sure that we don't go into lengthy diatribes about how grateful we are, because sometimes it gets a little emotional. You're just like, oh, I did not expect to see people in real life that know who I am, and it's interesting. So let's kind of like first, let's just dig into the general markets right now. If you want to bring up our YouTube portfolio, and we can kind of discuss each of the positions, what our thoughts are going forward, so that this way we can kind of, start off clean. And then maybe we can talk about some of the things that we're looking at actively as a way to, profit, hopefully, for 2026. So I'll just start us off at the top, and then Matt, you can kind of continue us down. Our first position, of course, is Apcellera. Very small position in our portfolio. It's mostly for tracking purposes at this point. It's a very small pharmaceutical company with some great leadership. It was originally backed by Peter Thiel. I'm not sure if he's still on the board anymore. I have to double check, but they've had some changes in their business model recently within the last year that theoretically could lead them to basically the promised land in the future. So this is something that we're going to keep our eye on, of course, and over time we'll still see if we have to build some conviction and we can go forward with it. ASTS, I don't think there's really much to cover there. I think we covered that last time. It's just communications via satellite directly to the phone. There's the recent developments that came out with regards to Starlink, and they're partnering with EchoStar that, may kind of diminish some of ASTS's competitive edge, but I don't necessarily think it's a big problem. It's just something that, hey, over time you're going to see competition, but competition has a way of just, bringing out the best in both companies. So I don't think that that's a big deal. I think ASTS is still a great play, long term, and you have to have a really long-term time horizon to be in ASTS. But I think with some of the more recent developments that I'm seeing, we're probably closer towards starting to generate real revenues than we were 5 years ago. So there is an entire community of people that Matt has definitely had his moments with, called the Space Mob. I don't know if anyone in the chat is part of the Space Mob, but but yeah. So please don't hate Matt. Please don't hate me. I am an ASTS bull. Matt is a Rocket Lab guy, and I know in the past there's been kind of a little bit of back and forth there, but it's all in good fun. So then the Brookfield preferreds, that's what I was saying. There's a whole thesis behind it. I'm not sure if we covered this in the past, Matt, but we'll cover it again. I think as rate cuts are happening, why these two specific preferred equities actually might be worth looking into for somebody if they're looking for fixed income. Then we have, of course, a small piece of Bitcoin. Basically, that is because you want kind of exposure to what's going on in the crypto space. It's not the biggest position for us. It's only about 2.7% of the portfolio.
I had to fight to get this position.
I mean, I have never really been a crypto guy, but the more I research, the more I'm starting to see what the value is. And even though BMNR is not here in this portfolio right now, it's something that I will have to have a conversation with Matt. And you know what? Maybe I'll discuss the thesis on here, maybe at a future time, or maybe even today if we have the time to do it. Norwegian Cruise Lines, great company. It's going to do really well going forward. This is not one of those things that you really have to worry about. It's fire and forget. We did unload a little bit of Carnival Cruise Lines to take that capital and deploy it into some of the other things because Carnival's running at the higher end of, in my opinion, some of its valuation metrics in the short term. If their metrics keep improving, of course, we have the option to re-enter. So, I'm not worried about that. Oscar is a play on the ACA and ICRA. So this is another thing that kind of we have to really dig down deep into to explain what the value of Oscar is. Oscar's trying to be disruptive when it comes to the ACA marketplace, where a lot of employers right now, they have their own plans and it costs them money, where now they could just kind of do hand employees the money and says, go buy whatever plan you want. And a lot of places they might end up choosing Oscar because, Oscar provides value for them and they get a selection on, what kind of plan that they want. So employers might benefit, especially small and medium employers who don't have the scale. So there's a whole thesis on Oscar. We'll go over that. Rocket Lab, we don't have to explain. I will say this one, I begrudgingly love seeing this go up, but at the same time, I'm like, God damn it, man, I missed out. But I'm just still not behind the business model. But I know that the community is strong and Matt's a believer, and I congratulate Matt and anyone who's gotten to this position at $4. I still remember the day Matt called me. He's like, bro, it's $4. It's like nothing. Just buy a few thousand shares. Like, what are you doing? And I was just like, I don't know, man. And it was probably one of the biggest mistakes for me in terms of investing. Sometimes just not listening to a friend. But I do know there are a ton of people who got into this and they have done extremely well. So congratulations to you guys. United Healthcare is something that me and Matt kind of we discussed very briefly, and that's something that I think we can talk about further on Cash Flow Chronicles, because one of the things I want to do is when we do pivot to 2026, I think there's a lot of great names in the managed healthcare space that could provide us a nice defensive way to play 2026, especially if we get any sort of a pullback in the general markets, because the market valuations are kind of up there. So, like I said, there's definitely value there. But once again, each one of these healthcare insurers, there's good aspects about them and there's bad things about them. So you kind of have to weed out the best players among them. In my opinion, UNH, largest, most scaled out, has multiple sources of income outside of just their insurance business. That's going to see them do well. So we got into this thing. Venture Global, I think we've always just kind of been bullish on Venture Global. We spoke about it to Earth's End. We have been selling covered calls on Venture Global. So, that's worked out well. NextDecade. And that's something that we can go over, because NextDecade recently got absolutely shellacked because of some of the expectations on future growth. Or at least the pace of future growth. And I think that's something that's a big detractor for NextDecade. So you saw them get downgraded by multiple rating agencies. Now, it's something that I think me and Matt will have to be cognizant of with NextDecade. But long term, this is one of those things that's going to be a winner. Now, ultimately, when you enter into a position, if you enter in at a low price, you're going to do extremely well as it returns to what it's supposed to be. But if you buy at a really unreasonable price, you're kind of like you're behind the 8 ball. At $6, I think there's tremendous amount of value for the risk in NextDecade. So right now might be a good time to kind of add to the position. And maybe I'll let you discuss it. What do you think about that, Matt?
But I'm curious. You said we have to be cognizant. What do we have to be cognizant of?
So a couple of things. According to the new information that NextDecade came out with, they are going to do a lot of equity financing themselves for their additional trains. So trains 4, 5, and so on and so forth. They're going to retain more equity in those upcoming trains. Now, that does provide for a lot of shareholder value, but, and here's the kicker. It also means that in terms of shareholders, you may not get a return until a much further out future date, right? So you might not get as much share buybacks. You might not get a big dividend. So a lot of that distributable cash flow, instead of working its way into the pockets of shareholders via these different mechanisms, just share buybacks and dividends, that might actually be reinvested back into the core business. So long term, it's a great thing. In the short term, it's short to medium term, it's one of those things that people are just like, well, when is my payback? When is it
Mhm.
coming? So remember, as an investor, you're always like investing for the future, but at the same time, as a shareholder, you kind of want to see some of those returns as well, right? So
So the way I look at it is one of two ways. I think you described that very well. The way I like to look at it is almost I was expecting dilution upwards of 50%. And so when you think about the amount of shares that you have, assume that what you had was going to be basically valued at 50% less than what you had, but they would have been able to cash flow more, if that makes sense. But the value of the shares that you would have had would have been diluted by 33%, if that makes sense, because they would have issued 50% more shares. So instead, what they're doing instead is decreasing the amount of cash flow they're going to get in the short term by, say, 20 odd percent, which I think is okay, and making sure they don't dilute the shareholders, which I think is okay. So to me, I'm actually okay with that. What's happening? I think that the way that the broader market is looking at it is a bad thing. To me, I was anticipating, okay, well, what ends up happening is my thought process is the value of what NextDecade is creating is going to be something that's worth in the low 20 to $25 billion market cap range. And so to me, that ends up being something that would end up being potentially, if you dilute it by 100%, something that would have, say, potentially 10x would now only be a 5x, because you have literally halved the value of the shares because they've basically doubled the amount of share count. Well, now if they're not diluting those shares, then potentially, yes, in the short term, you might have to fight off and have 20% less, say, cash flow or distributable cash flow. But overall, you're not having the amount of shares or the power of your shares anymore. You're only decreasing the value of them by say 20%. So I think I agree wholly with what you said there, Chris. I think in the short term, it provides a little bit more strain. But you have to keep in mind that they're going to start generating cash flow in 2027, 2028, 2029, and train 4, train 5 only really starts to come online in 2031, 2032. So they're going to be able to help supplement their amount of cash flow that's coming through the door, and their capital outlay with that. So
yeah, can you share the screen real quick? So this way we'll just go over that investor presentation. So what's great about these guys is they do a really good job of their presentations, right? And they're actually regularly update their construction and everything else. So right now they've got a full FID on train 4. And then they have an FID of train 5 coming in the fourth quarter of 2025, right? So FIDs are basically just final investment decisions. It just means that, the project is a go ahead. They've got the money to build this thing. They've worked it out with the contractors to make sure that, they have the materials, manpower, and everything else to build this thing out. Typically, FID is like the last stop before everything really starts to go in the favor of the shareholder in terms of value creation. So the challenge, though, sometimes is that this FIDing process can take some time. And from a regulatory standpoint, right now it's very, very favorable to build these LNG terminals. So what you're seeing is a lot of companies are FIDing at the same exact time. Now, the challenge that you run into is because of this, some of the analysts are saying, well, look, if everyone is building these things out all at the same time, that means that in the future, there's probably a capacity glut, right? So it's one thing if you're the only one producing this LNG terminal, but if there's 5 others, then, in the future, the buyers of LNG may not exactly want to sign up for a lot of long-term fixed contracts. They may end up saying, well, we'll risk it with the spot market and we'll just buy whatever the market price is in the future. And the thing is, to get financing, if you are doing, if you're relying on spot, is very, very difficult, because banks, they're not in the business of loaning money to projects that may or may not work out. I mean, and you're not talking about, hey, here's a few $100 million. These things are billions upon billions of dollars. These things generate tremendous amount of cash flows for like decades, but the initial upfront capital costs are sometimes very significant. So if you look at this presentation, FID of Train 4 is done. They've basically got 6 MTPA of capacity that Train 4 has. 77% of it is contracted, with another 23% left in the spot market. So spot market typically gets higher prices. The only challenge that you run into with spot is that it's not a guaranteed amount that you're basically going to get. And so this can work out in the company's favor, or it could be to its detriment, depending on what LNG prices are in the future. Venture Global has a lot more spot than NextDecade does. So NextDecade is saying, look, we've got enough future projected cash flows that we can leave some of our additional capacity in the spot market, so that in the future, if let's say LNG prices go absolutely berserk because Russia decides to invade Poland now, and natural gas goes to $100 an MCF, like that happened to Cheniere, then they'll be able to capture a lot of that value. Same thing if we get a couple of cold winters. They call natural gas, they call it the widowmaker for that reason. It has a lot of volatility in the underlying commodity. It's not like just, up and to the right. There are times where this thing can go 5x and then it can come down 5x. So the more you rely on spot, the less likely it is that you're going to be able to finance that with your traditional debt. So what you're seeing here is that this is something that I was a little bit surprised at. I thought Train 4 would be online in probably like 2027, like not maybe 2028 at the latter half of 2028. But the way that these guys are constructing these guys are using more traditional LNG liquefaction than what Venture Global is doing. And we could discuss that too, because there's two different technologies at work here. Venture Global is using small modular pre-built liquefaction trains. These guys are using on-site construction. It's a much larger project, but that's what these guys have chosen to do. And we can kind of discuss the benefits of each of those things. But the total cost of that is about $6.7 billion. They're financing that with 60% debt, 40% equity, which means that debt is going to have to come from issuing, borrowing money. That borrowing money is also something that, I was not expecting to be as high of a cost. But once again, if you're relying on a lot more spot, then this is something that you have to kind of keep in mind. So the facility right here for Train 4 bears interest of SOFR plus 200 basis points. What is SOFR? SOFR, overnight funding rate. So basically, that's like if you go to like the Fed funds rate, it's very similar to the Fed funds rate. It's borrowing money overnight. So if you ever get an adjustable loan, especially on the corporate side, this is what it's going to be. So whatever the current federal funds rate is, just take that at 200 basis points. So if the federal funds rate is 4.5%, then you add 200 basis points, it costs you about 6.5%. That's what basically the cost would be. So if, let's say, the Fed cuts rates by 200 basis points, now all of a sudden your interest costs go down. So these guys, of course, they probably believe that in the future, interest rates are going to be lower. SOFR before the year 2000 was near zero. So that means that you're only paying 2%, right? Which is pretty crazy. So this is how they're financing their debt portion of it. There was one thing that their term loan that they have here, and then this other one, their Super Finco loan, those have a lot of cost. Okay. So if you see here, the long-term funding rate, it's SOFR plus almost 350 basis points. That is a lot. It's like 4.5, 5 right now. And then you add another 350. So you're paying between 700 and 7 and 8% interest. And then there's another one that's a term loan that's 13% interest, right? So it's pretty expensive. But remember, NextDecade does not generate any money right now, zero. So in order to operate, they need this money to keep things going. So eventually, though, the benefit for shareholders is as the cash flows start coming in, like Matt pointed out, in 2027, they can refinance this down to much, much lower amounts. I mean, with this one, they don't really have to worry much because interest rates, if they come down, it kind of benefits them anyway. But this one, I'm sure that they'll probably get another credit facility at a much lower cost. but basically this is like the debt structure that NextDecade has. All of this stuff is basically irrelevant to most investors. And we can go over train 5, the unit economics of it. But the point that I think the reason why we got those essential downgrades from Morgan, I think it was Morgan Stanley that downgraded them, is this part right here. So here, what's up, honey? Oh, thank you. The wifey, she's like, get you some hydration.
Where's my water?
Take a breath. I know, right? So you gotta get yourself a wifey, bro.
You gotta get me a sugar mama.
So you can see here that with full trains 1 through 5, they're expecting about, on a cash flow basis, 2.1 billion in distributable cash flow. Now, let's say it was just that. Right now, the market cap of the company is like what, 1.7 billion? Matt, is it something like
Sounds
that?
about right.
Yeah, you're talking about generating 100+% return from distributable cash flow if you start collecting that kind of money. But of course, there's other portions of it, which is the interest on that debt, right? So you can see here the NextDecade project level interest. So not all of that money is coming directly to NextDecade. So they have partners that they have on their first 3 trains that they have to pay. So out of that 2.1 billion of distributable cash flow, 1.4 of it is going to go to their equity partners like Mubadala and Total and everything else. That leaves them with about 700 million, still a pretty respectable amount. And then after that, they're also going to have some costs for interest, and then general administrative costs, which are going to run about 200 million. So the distributable cash flow is going to be about 500 million. So in terms of an investment, it's still a really good, return for your money. They also have something called the post-flip thing that's going to happen in the mid-2030s, where some of the margins that they have the option to basically get more of their equity back from their partners after certain conditions are met. But the real long-term value of this investment actually comes from this right here, which is trains 6, 7, and 8, because once you start that cash flow process and you're getting that money, you can use that money to now leverage to build more trains. And those trains, you have much, much bigger equity stakes. And that's where you get this, what is it called? Like that wheel, the what is it called, man? I'm blanking right now. See, I'm getting old. That's where you're going to start to make a lot more cash flows in the future. Now, the challenge with investing in a company like this is that train 6, 7, and 8, you don't exactly know when they're coming online, right? They haven't been FID. They're still in process of talking about it. It's not guaranteed that it's going to happen. And the timeline where this thing is actually going to generate you like really, really strong returns, it's much, much later in the future. So in terms of like, hey, do I still have time to buy NextDecade? I would not shy away from saying, yeah, we've got plenty of time while this whole thing works itself out. What do you think about that, Matt?
I mean, it really all depends, right? I mean, once there's cash flow on the horizon and people start to actually see money coming through the door, that's, it's going to be a quicker amount of time than people really think. And so I don't necessarily know. It's really up for people. But what I will say is, don't be buying into this because you think it's going to go to $15 overnight, right? And this is something I've always been telling people. For this to truly pan out, you really have to have a long-term time horizon, as we've always kind of had with this one. And I always kind of make the joke, recording voice notes for people, is, people are buying into NextDecade and they expect money to show up next quarter, right? It doesn't make any sense. You're buying this because it's truly going to take a long time for these cash flows to actually start to show up. But I think the most, like you stated earlier, the most beneficial piece of it is that you will potentially see a large amount of cash flow actually start to come through. Like post flip from these 5 trains, $1 billion in cash flow. If you think about it, that alone can be upwards of, in the early 2030s at this point, if you think about it, that alone could be worth $10 billion, right? So that's if we're able to keep, all, and that's before you start paying some of these things down, right? If you think about it, that's before they pay things down, refinance, etc., which is something that's going to happen. So eventually the buybacks are going to show up, the dividends are going to show up, they're going to refinance these things and hopefully be able to get more favorable interest rates. So there's that piece. And then they actually get 100% of train 6, 7, 8. Those are going to show up in the middle part of the 2030s as well. Who knows what cash flow those are going to start to show up at. So you really have to think, though. I mean, you are going to have to wait around, right? So there is time value of money, and if you think that there is a better opportunity out there, there's something to put as, where that as well. But I don't think that this is something that's rocket science, right? It's not like you're trying to put a man on the moon. This is something that's happened before. To me, it makes pretty good sense, right? It's something that I'm pretty familiar with. And so in that respect, it's nothing too crazy, but I think it's just up for people to understand what's the risk tolerance, how long are they willing to wait. I think a lot of times what I end up hearing is, I always tell people this is going to be a while, and next thing you know, they're like, well, why isn't it moving? And it's like, dude, like, what do you mean? Like these are big $1 billion projects, right? I mean, we're talking about things that take 5 to 10 years to actually get installed and start up, right? I mean, Venture Global is a little bit of a different story, but even still, we're talking about it's going to take time for these things to be developed. It's not a piece of software where you can kind of develop it within 18 months and start selling it, almost immediately. So,
infrastructure plays, like I said, they're very expensive when they start. But once they get the ball rolling, it's like a super cycle for them, and they just start to print money. I mean, you look at like an example that I could give, a really good one is LNG, Cheniere Energy. So let's just take a look at the stock price of that real quick. So when Cheniere first came out and said, look, we're going to build liquefaction terminals, this is what it looked like right here in 2009. It went $2. Energy prices went up. It stayed roughly, about $60-$70, and it got to as low as $32 in 2020. Okay. But after that, their cash flows just went berserk. And look at this, 10x on people. So imagine someone had bought at $3 and then now they're sitting on 230. That's life-changing money. Okay. That's like beyond life-changing money. And that's a $51 billion market cap. So you're looking at, and my project and Matt fully FID'd trains 1 through 5, you're looking at probably about 20 billion roughly, right? Without taking into account any share buybacks into the mix. And because they're retaining more equity long term, it's actually going to work out well in their favor. If the cost of capital goes down, that means that the cost of that interest that they're paying can go down as well. So you're looking at generating a significant amount of return, but it's not going to happen right away. And the thing is, as you move closer and closer to that date that you are going to see that exponential return, the value of the share should follow along with it, right? So as timelines progress, like if you see here at $34, as timelines progressed, it doubled. So it went from 2016, where they were not producing any LNG, but the date at which that first LNG was going to start coming in was getting closer and closer and closer. And I think their first LNG cargoes actually went out in 2019, right before COVID. And that was like a great buying opportunity. I wish I had really done more due diligence on this, just bought a ton at the time. But after that, it's all she wrote, and it's been doing amazing since. So let me just double check. When did they first start shipping? Cheniere signed an agreement, 2010s. The company grew significantly, and in 2016 became an exporter of LNG.
Yeah, I thought it was 2016. Yeah.
Yeah, so I think that's when they're literally their first train started to come online. And ever since then, they've just been building more trains, taking that money, deploying it back into the business. And the other thing is they have a pretty good dividend on it, right now. So if, let's say, you bought it at $3, you're getting, let me just see what the current dividend is. Hold on. LNG dividends. Let's see. Okay, they're like 50 cents per quarter right now, right?
Mhm.
So if you're thinking about you're getting $2 right now. So imagine you bought this thing at $3, held for 10 years, and now you're getting like 75%, like what is it, 2/3 of your money back every year. That's a pretty good investment. I mean, $3,000. Let's say you put, I don't know, $100,000 in it at the time, you would have got 33,000 shares. Those 33,000 shares multiplied by 230x, no, 230. It's a pretty damn good return, you know. So I'm
Yeah,
not
I
saying
mean,
that, by the way, that's going to
the way
happen.
I look at it is, I think at the moment, I think that they're valuing trains 4 through 5, the value to NextDecade, right? So I think the project itself, I think, is going to generate. I think in the presentation it says $2.5 billion to the overall Rio Grande project after interest and everything of the like, and then I think of that 1.2 billion after the flip will go to NextDecade because they own 20% of trains 1 through 3, and then 40% initially, going to 60-ish%, 65%, I guess, if you call train 4 and 5 combined. So they'll own 60% of train 4, 70% of train 5. So this is called 65%. So they'll own 65% of train 4 and 5. That'll end up being about $1 billion in cash. I mean, if you think about it, let's just say they take 50% of that and eventually do some sort of, say, dividend or something like that. They'll probably end up putting half of that back into some sort of shareholder distribution, and that's not even the full opportunity. I mean, the one thing that I saw within the presentation, which I thought was very interesting, was they kind of started to talk about what the long-term objectives are of the group. And of course, safe operations is key, and that's number one. Second, obviously, was maintaining investment grade. So focusing on making sure debt doesn't get out of control and making sure that they don't get anything too crazy in terms of debt. And then one of the fourth things that shows up actually was potential organic opportunities, which I thought was interesting. And you and I have talked about that in the past, Chris, which is obviously they want to grow 6 through 8. 6 obviously has the ability, the 6th train has the opportunity to show up within the actual current flood walls that has been designed. 7 and 8, I think, are relatively easy, but there's other areas within the Brownsville ship channel that have been signaled for LNG facilities that aren't really progressing forward right now. Or will they potentially be an opportunity for NextDecade to expand and purchase those? You know, and so with that, you know, is there an opportunity to continue and grow the footprint even more so? And if that's the case, could you end up being in a company where it's beyond 25 billion? It could go to 35, 40. I don't know, right? Where does the buck stop? Where is the actual opportunity lie in the long term for where they actually stop, right? Cheniere initially was, people were just thinking about Sabine Pass, right? And what was going on with Sabine Pass. Then they started talking about, okay, Corpus Christi LNG. Then they're talking about expansion projects. So there's so many, when you think about it, so much opportunity with some of these things. And if given the opportunity, you know, they can continue to expand or even, you know, progress. The world, I think that people don't fully understand this. The world needs LNG, and the United States is in a key position to supply 40 to 50% of the market share for the world. And I don't think that people fully comprehend how bad of a position, and I can't speak too much on this, but I don't think people fully comprehend how bad of a position the other countries are around the world. I think in all honesty, the only country that is doing extremely well in terms of LNG and making sure that things are going well is Qatar. And Argentina's doing well. I think they're going to be installing some FLNG plant off the coast, and I think that'll help with some short-term opportunities. But FLNG is a little tough. You can't get a lot of capacity with FLNG. but the other piece I think that's interesting potentially is Guyana. What happens with the excess gas? Because obviously there's obviously all the projects going on with Exxon. They just started up their fourth oil boat that's obviously producing, but they're re-injecting all that gas. What are they going to do with once that oil is all kind of depleted out of the reservoirs, and you're just stuck with that secondary gas? Will they actually use that gas and export it? So will they end up eventually setting up an LNG facility in Guyana to export globally? I think that's something that's pretty interesting to think about. You're talking about potentially 20 TCF of gas. That's a lot of gas. It's the equivalent of what Trinidad and Tobago is on its own. So, and that's obviously been a huge provider of natural gas worldwide and an LNG exporter itself. So, that is that the old hat of Australia and a lot of other countries that have been predominant in the 1990s and early 2000s with natural gas production, unfortunately, have regulated themselves out of the business. So unless that changes, it's really going to have to come from the Qatars and the United States of the world to really help meet the shortfalls of the rest of the world in terms of natural gas export.
Yeah. The other thing with natural gas, though, is the cost of energy. If governments would sort of get out of their own way, would be a lot more beneficial for their constituents. So let me give you an example. While I am a firm believer that we should all eventually transition to renewable energy, renewable energy is still not there in terms of total baseload capacity where they can fully replace fossil fuels. Fossil fuels are going to be with us for at least another 50 to 100 years. All right. I don't care how much you think like wind is going to take over and solar can become more efficient. Most of the the output right now in terms of total energy production is coming from natural gas. While nuclear is also very promising and the US is really pioneering it with SMRs and everything else, there are still a lot of places on the planet that cannot get nuclear, and the cost of producing nuclear, both from a security risk standpoint, is very high. So there are still pockets of the planet right now that rely on fossil fuels and the dirtiest type of fossil fuels. And I think eventually they will transition to natural gas, which it does not emit, like carbon dioxide, but at the same time, it doesn't have a lot of the other things that cause like acid rain. So as an example, if you go to like India, there's still a lot of energy production over there using coal, and transitioning them away from coal is a big help in reducing greenhouse gas emission. Doesn't mean that, like India's trying to industrialize. They're going to utilize more energy. Everyone on the planet is going to use more energy. Okay. These data centers are coming along for AI, huge demand driver there. You're looking at the EVs of the future. If people are transitioning away from gasoline, and a lot of countries are trying to really produce more EVs, where do you think that electricity is coming from? There aren't enough solar panel in some parts of the country, like the world, you're not even solar makes no sense whatsoever because they don't get as much sunlight and they don't have any capacity for wind. So while renewables are a great way to, generate electricity carbon free, there's also a lot of limitations that they have that are not going to get solved for quite some time. So LNG can be that bridge fuel that gets us to that destination. And also remember, from a human standpoint, you want to also, not have your country basically freeze to death. And I think a lot of the Europeans, they realized that because they became so reliant on Russian LNG, Russian natural gas, that when Russia invaded Ukraine, they got screwed over. Thank God. And right now, the Europeans should be glad that companies in the US innovated the crap out of themselves and got these LNG plants going during the Russian invasion that helped supplement a lot of natural gas going to Europe. Now, with a lot of these facilities coming online, what they should do is stabilize the price of natural gas in the future, where it's going to be a lot more predictable The only challenge is that the Europeans might become more reliant on US LNG and bring us closer together. So, I mean, some of the Europeans are not exactly big fans of that, to be honest with you. They're like, look, we like America. We just don't love America because y'all have a way that you guys kind of utilize your power to have control over you. But at the same time, the US is also like one of the most reliable partners in terms of energy security. So we want our allies to be more dependent on US LNG, and I think that's why you're seeing a lot of contracts being signed by South Korea, by Japan, by Southeast Asia, and even India is starting to kind of get into the mix of things, and they're importing as well. So the demand for US LNG is going to remain strong for as far as I can tell for a really long time. There's no alternative source of energy that are going to be able to disrupt these guys yet. So I do think that there might be sort of a glut, and I am in agreement with this narrative that because of all of these projects coming along around the same time, which is the late 2020s and early 2030s, that there could be a lot of LNG on the market. But at the same time, there's also going to be a lot of demand. And so eventually that demand is going to catch up, right? So even if we do have a glut, like a period where maybe like a year or two where spot prices are a little bit lower, they'll correct themselves within a couple of years where demand is going to pick up, and there you go, we're done, and we're back to normal again. I think this is where you got to love Venture Global and Mike Sable. These guys. So did you see that interview a while ago that Mike Sable did with CNBC? Let me pull it up. Actually, I think I have it. He basically said, our goal is to become the largest exporter of natural gas in the United States, because they are, and these guys are just animals. They're building these LNG terminals with like 2 years, 3 years lead times, where everyone else is doing like 5, 6, and 7 years. And they're just building like crazy. And at the same time, they're maintaining their costs pretty well. They're just like, we're going to undercut everyone. We don't care. Everyone else is selling at $2.50 per liquefaction fee. We'll sell you it for $2 or $2.20, because our cost of to liquefy is just that low because we're that efficient. And so I think a lot of people are getting a little bit nervous. They're like, wait a second, like, should I, like a lot of banks are saying, should I even FID a project? Because there's these guys called Venture Global. They're just out there just producing at a substantially lower price than everyone else. And it's really hard to justify going to an alternative when it's like a gas station, right? If you go to like a corner, like a cross section, and you see like 3 gas stations, you got the Sunoco, you got the Exxon Mobil, and you got the Chevron. And the Chevron, their price is like $3 and everyone else is $3.30. Everyone's going to naturally go to who? The guy who was selling for $3, right? So eventually the Sunoco and Exxon Mobil, they're going to have to either lower their price or they're going to go out of business because there's going to be no demand. So Venture Global is like, look, we have the ability, because now they're cash flowing. They're generating 6 to almost 8 billion in they're projected to do 6 to 8 billion sometime in the next couple of years of EBITDA. So they're like, we can sustain ourselves on the spot market, and we could just undercut the shit out of everyone. So these guys, in terms of ruthlessness, I've never seen a more ruthless duo than Mike Sable and his partner. Let me just share that clip real quick. There you go. Can you put it up?
Global CEO Mike Sable. Mike, nice to have you. Congrats.
Great to be here. Thank you very much.
How do you differentiate your company from competitors such as Cheniere or Freeport, which is a private company? In reading the S1, it seems to be in part the way that you actually manufacture and construct your trains in terms of a different way and perhaps more speedily. Is that correct?
No, that's correct. We're the first ones ever to shrink the size of the liquefaction train to where we can build it in a factory. And it's originally how my partner and I, Bob Pender, were thinking about it, is really Dell servers with AWS replacing IBM mainframe computing. And that actually was part of the conversation that we had way back with Jeff Immelt 14 years ago.
Does that enable you to do it at a cheaper cost? And I wonder, I mean, so many of these things still have cost overruns. You manage them in a way that perhaps your competitors don't as well. Is that fair to say?
Yeah, we think that we're by far the lowest cost liquefier in the world, and it's an exported gas market, so it's a commodity market. So having low cost is key to rapid growth, and I think we're one of the fastest growing energy companies in the world right now.
You are in arbitration with a number of your key customers.
So this was before. The arbitration's actually been settled with Shell, but there are other ones that they're working on. But the results should theoretically be the same. But the point is, these guys, they liquefy at a much, much cheaper price, and they can actually generate a return on that. And it's pretty insane to see what these guys are doing. And so they're undercutting pretty much everyone else. The only challenge that Venture Global has is that they did some stuff where the price of natural gas had gone absolutely berserk during the Russian invasion. And so these guys were still in the process of doing commissioning cargoes. And so they were selling them on spot and generating huge profits, which was within their contract to do. And that's why they ended up being in arbitration. But the point is, but they're ruthless. So a lot of counterparties, they're just like, I don't know if I could trust these guys to sign a long-term fixed deal with them. And so now that they're actually generating cash flows, and I don't think Venture Global is that reliant on the super majors for financing nearly as much as they were in the past. It's not to say that they're not still signing deals. It's just they're not as dependent on, let's say, NextDecade is for long-term SPA deals. Now, the challenge with that, of course, that Venture Global is going to end up facing is that because they're more dependent on spot prices, if the price of spot goes down significantly, it could impact their earnings, in the short to medium term. So, yeah. Any opinion on that, Matt?
What was the question?
No, so Venture Global's business model exposes them to more spot pricing, which could be either beneficial for them or a downside depending on the price of natural gas.
It could be. Yeah, I think that they've done a good job though of specifically getting their projects online faster. So the return profile, even though they might be able to charge less, the fact that they're able to shorten the economic cycle for them to get online faster, you have to think it allows them, when you're evaluating projects, to come online 2 to 3 years faster than anybody else. The discount rate is that much better. And so you don't have to wait for it to be discounted, say another 20 or 30% before you actually start producing or exporting in this particular case. You're actually able to get the present value of some of these things 2 to 3 years sooner. And so even though you might be charging less by, say, 25 or 50 cents, you're able to get the value of those things much faster. So in all reality, you're probably ending up getting a net break even, if not even slightly better, just based off that fact, if that makes sense, right? Because the way you look at it, if you do a discount rate of, say, 8 to 10% because of the cost of capital, right? In the case of, say, what we're talking about with VG, a lot of their debt is at 7%. If you're doing a, say, cost of capital of 7%, and you say do that over the course of, say, 3-4 years, that means that they're able to charge, say, 25% less, just based off the fact that they're able to get it online 3 years earlier, because 7% discount rate over 3 years, right? So in that respect, they can do that and still beat out their competitors. And still make a profit, very much so. And in the short term, while they're still commissioning and getting things up to speed, and a prime example is what they're doing with the Plaquemines project, they're still getting things up and running, trialing things. And since it's modular and you don't have these large trains, so key example is what they're doing at the Rio Grande project with NextDecade. You're talking about a project, trains 1 through 3, so 3 large trains, which is comparable to what they're doing at Plaquemines, which ends up being 36 trains. So literally 12 times the amount of trains, if that makes sense. you're able to kind of plug and play a little bit easier, and so start to commission things over time versus having 3 large commissioning periods that you would with, say, Rio Grande, and allows them to ramp up over time as they have been throughout the year. And so it allows them to also tweak things, make things, make it a little bit more adjustable. And they've actually been able to demonstrate that with this design, they're able to get about 30 to 40% more capacity uplift comparatively to what a typical LNG facility might look like. And they're actually in the process right now. I don't know if you've seen this one yet, Chris, but they're actually in the process right now of updating the Plaquemines' original capacity from about 18, 19 MTPA up to 24, 25 MTPA. And so that's just for the original project. And I think that they're actually getting that pretty much on track. It's pretty interesting.
Yeah, they're from what I read, man, they're really like turning up the juice in terms of total production. They've got a whole bunch of bolt-on things as well, so like brownfield projects. So that's another thing to just keep in mind. When you do these projects, there's something called greenfield and brownfield. So greenfield is if something is already, well, something is just basically trees and stuff. You have to kind of knock all the trees down. You have to build the infrastructure there. You have to build a lot of pipelines to that destination. Then you have to build the shipping portion of it that allows you to kind of do the dock work. Then you have to, if you have a channel, you have, like a port, you have to kind of dredge it to make sure that the ships are deep enough to go there. So the cost of doing projects like that is very expensive, but you can do additional things on it with near like adjacent project to it and basically do it at a much cheaper price because you already have all the infrastructure built out. You don't need another pipeline to connect. You just use that existing pipeline. So these guys own all the pipelines going to these sites. They own the channels already. So these bolt-on expansions that you see here, pursue bolt-on expansions at Plaquemines and CP2. This is going to be done at a much even cheaper price than the original construction costs that were there for both the Plaquemines and the Calcasieu Pass facilities. So once again, these guys are just on another level of develop. But once again, these guys are also in the process of, hey, listen, we could take a lot of the money that we're generating right now, this EBITDA that we're generating, and basically give that to shareholders via dividends or buybacks. But we're actually going to take the opportunity right now while the regulatory environment is favorable via the Trump administration to just reinvest all of that money back into building more of these things out at a really fast pace. Because God forbid 2009, well, not God forbid, but let's say 2009, the Democrats take over and they go back into, hey, we are going back into green mode. We're not authorizing any more construction of LNG terminals, blah, blah, blah. Then you've got yourself a problem because now you want to build this out for extended growth for your shareholders, but you can't, right? Even if there's tremendous amount of demand, you get bogged down by regulatory hurdles. So while the regulatory environment's in their favor, they're just like, screw it. We're just going to take every little bit of cash that we have and just plow it back into the business so that in the future, these guys can become probably the ExxonMobil. I mean, that's their probable goal, the ExxonMobil of the natural gas world. Now, what does that mean for shareholders? It means that there is tremendous amount of cash flow coming our way. I just can't tell you when it's going to be. And right now, the valuation, even at $12 a share, is about 30 billion, right? 30 billion market cap. So, and they have a lot of debt on the balance sheet. Because remember, if you're trying to move fast, sometimes you got to pay up to move fast. So these guys took on a lot of debt to really get the ball rolling. But if you look at it from like a debt to EBITDA standpoint, in the future, they're going to be paying down some of that debt. They're going to be buying back some of those shares. And at the same time, using some of that excess cash to build more facilities. There will be a point where they stop building more facilities, or at least building them at a slower pace. And that's when we as shareholders are going to make out like bandits. Because
I think it's going to be a good opportunity because we're entering a rate cutting environment, and they were able to get I was looking through this earlier with the most recent. We're about to exit the third quarter, but the second quarter I was going through specifically their debt stack, and they still have about 10 billion associated with the Plaquemines construction loan. So they were able to kind of prepay 2 billion of that, and they were able to finance, say, 4 billion of it and put it into term loans. But I think that until you kind of have Plaquemines fully put into term loans and no longer have construction loans, I think it's going to be tough for people to fully understand what the cash flow looks like for them, because right now, as you know, the construction loans kind of show up as kind of more of a floating rate sort of environment. So it's very dependent upon like the interest rate swaps that they're doing and things like that to help shield from kind of what's going on. But as now they're getting Plaquemines fully online, I think on a quarter by quarter basis, we'll see more and more of them being able to issue these bonds like not bonds, this debt stack like they did in the second quarter. They issued about $4 billion worth of debt and then replaced that and prepaid out the construction loan. So now you're able to kind of say, okay, when are these things due? What is the interest rate? And if we're entering now a cutting cycle where, let's just say, you are able to get 50 basis points, 100 basis points off, you actually potentially might show up with something in the 5% range comparatively to where we are now, which is they were showing up with stuff in the low 7% and mid 6s. So fingers crossed.
Can you share the screen real quick? So this is their current long-term debt stack that they have. So these are all yielding about 8, 9, 7, 8. Remember, a lot of this stuff was issued during the initial construction of like Calcasieu Pass. So remember, when you're not generating any returns, borrowing money comes at a very expensive price. Okay. So imagine right now you're a college student, not a college student, you just graduated high school, you go to the bank and say, hey, you lend me money. And they're going to say to you, yeah, okay, I'll lend you money, but it's going to cost you like 10, 15%. But let's say you give an acceptance letter to Harvard, they're going to say, yeah, I'll give you 7, 8%. And then if you already start working and you're making money, the banks are going to be like, I'll lend you this money at 4%. So if you use that as the example, these guys have basically graduated from Harvard now. So a lot of this higher end debt, if we do go into a rate cutting cycle, this is all going to be drawn down. And that means that all of this money that's going right now into paying interest on the existing debt instead is going to be going to us as shareholders and also back into the company. Now, there's one thing that people have to understand when it comes to this debt that they have. It does not show up as an interest rate expense, because while things are being constructed, that debt goes into capitalized cost, right? So imagine right now you're building a house. Now you have to pay your contractors, you have to pay all of these things. So when you're, paying these people, you're still borrowing money from the bank, and the bank is still charging you interest on it. The thing is, you roll that cost into the cost of building that house. Why? It's because from a tax perspective, you can use that as depreciation later on. So even if it cost you $25 billion to build a facility and 4 on top of it was interest, that means that now you have 4 billion that you can expense as the cost of building, and you could depreciate that over the period of this or in the future. That's important because that is money less that we have to pay in taxes for, right? So just keep that in mind. So a lot of times we'll look at this and be like, wow, like how are these guys going to afford all of this debt that they have to take on? It's going to cost them all this money in interest. Well, they roll that back into the cost of the building. So that's why if you look here, capitalize. Let me see. Man, if there's one thing that ChatGPT has done, it's made me a terrible speller right here. So you can see during the 6 months, management determined was probable for construction completion, subsequent costs associated with development, construction, terminal, associated pipeline, including capitalized interest, have been capitalized as construction in progress and advanced equipment payments. So like I said, from a tax perspective, these guys are awesome as well. So the one thing I really like about Venture is that both of the guys at the top, one's a banker and one's a lawyer. You know, you can't get any more ruthless than that kind of management team. You know, they're not your traditional energy executives. So, you know, yeah.
Yeah, and going back to what Chris was stating, I think at the end of 2024, the company was really only generating about $2 billion worth of EBITDA because they only had the one facility online, and they had seen a massive decrease in the value of the export spot prices, and so with that, they had still about $25 billion worth of debt or so on the balance sheet. So when you looked at it in that respect, the debt to EBITDA range was massive, right? It was over 10 at one point. And so people were looking at that like, holy crap, that's a lot, right? And will they be able to actually pay this off? But with the now bringing online of the Plaquemines project, and now pretty much the tripling, if not quadrupling of the EBITDA, and the debt now kind of staying rather flat comparatively over the past 6 months, now the debt to EBITDA has shrunk by threefold, right? So now it's getting to something more reasonable, getting closer to a debt to EBITDA of say 6, and will only get better as you bring on more and more production or export capacity rather into the latter half of this year into next year as well, keeping in mind that you'll have a full year of full capacity of spot pricing for next year. So if spot prices pay out as well as they did hopefully this year for the Plaquemines project into next year, then potentially the debt to EBITDA will look even better. And then if you get CP2 online towards the second half of next year, early 2027, then it's only going to shrink again. Keeping in mind though, they have to figure out how much they're actually going to be paying down the actual debt itself. So it's a game of balance because the return on equity is going to be something in the 30 to 40% range. And so would you rather return that capital to shareholders and pay off the debt over time? Or would you want to pay down the debt earlier? It's I guess a question for management to make sure, because at the same time they want to maintain an investment rating that allows them to get cheaper interest rates as well. So, which they just got upgraded over the past 2 months or so.
The one thing I also noticed about them is that they're heavily going into the utilities market. So, in terms of total, what is it called? Like customers, they're much more vertically integrated than everyone else. They own the ships. They even bought a regasification facility in Europe. So they're like, look, we will get you natural gas at a reasonable price in the future. We own the pipelines that connect to the facility. We own the liquefaction trains. We own the shipping portion so that just in case, like, let's say there's a demand spike and chartering rates go off the chain, they'll still be able to deliver without much of that cost being, borne by the things. Now, for a utility, dude, that's amazing. If you can guarantee a utility a fixed price, they'd love that. So you can see here, one of the things that they actually showed in their investor deck was actually interesting, which is the wholesale cost if they were to use $11 TTF for what is that thing? For natural gas from Venture Global, it would actually cost the UK about 8 cents per kilowatt hour. The current wholesale cost in the UK is about almost 15. Look at that. Like, these guys could save you money as long as you guys would import a lot more from us. And I think this is what they're going to basically like go to what is that thing called? Go to the UK and be like, look, right now you've got the Labor government, which is a little still more on like the, hey, restrictor side. But, if you get something like reform is going to say, we want to lower electricity prices and heating prices for our seniors, for our citizens, right? If you ask anyone in Europe, their electricity prices, bro, they're crazy. So if you can say, hey, we can get you electricity for cheaper, that means that that's just an aggregate demand driver. Now, the thing is, you have to vote in politicians that are a lot more favorable to allowing things like this to occur. So, it's a give and take, but it's definitely a better deal. So, in terms of if you're a supporter of if you live in the UK and you want cheaper electricity prices, venture global.
All right. So I appreciate talking about the natural gas space. I know a lot of people have been asking about NextDecade, specifically with the price retracement. Curious about your thoughts tomorrow. We'll probably end there, just knowing that we're running at about an hour and a half almost. And I do have to hit the bed and go to work in the morning. And I know you're about to start your shift as well.
I think we're going to get a rate cut. I think we're due for about 3 rate cuts for the rest of this year. So they're not going to do a 50. I really, really doubt they're going to hit a 50. But if they do hit a 50, bro, the markets are going to rally like crazy. But I think a 25 basis point cuts is actually very warranted. The data that I'm looking at right now, 3 things are going really, really south really, really quickly. And maybe this is something that we can catch up with the next time we do Cash Flow Chronicles, which is the state of the economy. And I think it's deteriorating faster than people think. So I think the economy is a bit bifurcated right now, where the haves are doing extremely well because they own a lot of assets, but the people at the bottom, they're absolutely getting crushed by unemployment. They're getting crushed by housing costs, and they're getting crushed by inflation. So yeah, that's something that we have to take into account. The one thing about it, though, is that inflation is coming down very fast. So I think it gives the Fed a lot more room to navigate and cut. So, yeah.
Mm-hmm. So I have you on here, the 10-year. I have a question for you. This is obviously has come down. The 10-year is a proxy for where mortgage rates are probably going to go, right? Obviously, we've seen mortgage rates kind of being at the 7% range for 30-year mortgages over the past several months. Some of the highest we've seen over the last 10 to 15 years. Now they've been kind of hovering around the 6.25%, 6.5% range. Do you think that quarter percentage basis point is cut, is already priced in? Do you think that this will potentially ignite where we've been? I think we've seen a lot of stalling nationwide of home sales, some of the slowest home sales we've seen in quite some time, which obviously is drawn a slowing in real estate markets kind of nationwide. Do you think that this quarter basis point cut would help reignite that, or do you think you need more than just a quarter basis point? You think you need the 3-4 cuts, a whole percentage point on the 10-year to really make it more reasonable for people to go back out and buy a house?
Brother, you do not want to hear what I'm about to say, but I'll say it anyway. I think we're in for somewhat of a correction in the housing market that's going to be felt at least for five years, if not more. And let me explain the thesis behind that. Right now, you're starting to see 3 confluences in the real estate market happen. Number one, the prices of homes are just absolutely crazy right now, like relative to median income. And I can show you the data on that at Land to Fed. So let me just show you. And one of the things that we might be seeing is an inventory unlock with when rates start to come down. So you can see here from an affordable, to share my screen real quick. So you can see here nationally from an affordability threshold, from an affordability standpoint, as long as the total monthly cost is about 30% of the median income, you're fine. You'll have, of course, periods where things go a little bit above, but 30% is pretty good. So if you look at the median income of the United States right now, the median income, household income is about $80,000. It's always going to keep going higher and higher because that's just how inflation works. But the median price of the home is about $399,000, almost $400,000. At the current interest rate, which is 6.7%, people are expected to pay about $3,000 per month in the cost of buying a home, which is very, very unaffordable. Now, even if you were, and you do the math on this, even if you were to lower interest rates by 200 basis points, and let's say and the interest rates go down to like, let's say 5%, right? So right now it's 6.7. It goes down to, let's say 5%, which is about 170 basis points. You are still looking at probably another 15 to 20% correction on the price of the home in order to get back to its affordability threshold. Now, the challenge that you're going to run into is you're starting to see a lot of the boomers die off. Okay. So as these boomers start going, they're leaving these homes to their kids, and some of these kids don't live in the area. They live far away. They may not have kids. Their kids might, not want something so big. All of those factors mean that those homes are going to be coming on the market. So you've got that happen. So you've got more inventory coming from boomers ready to leave. Now, this doesn't mean that like, oh my God, every boomer is going to sell their homes at some point. Like, no, it's going to be like a cascade of inventory coming online. And at the same time, if you look on the other side, the younger generation, the millennials and Gen Z, they can't afford to buy these homes because they're saddled with a crap ton of debt from student loans, from credit cards, from all this other stuff. So they're not exactly in the best position to buy, and none of them are really having that many kids. Like if you look at the total amount of people that are actually getting married, it's actually some of the lowest in the history right now. So people are waiting to buy homes much later into their 30s if they ever get married at all, or if they even ever have kids. So you don't need a 4-bedroom, 5-bedroom house if you're just by yourself, or if you have, just a wife and a dog, right? So you're going to see a lot of this inventory coming online. And then we've kind of cut off net migration, right? Immigration's kind of down, and right now we're actually going into negative migration mode, which is there's more people leaving the country than coming in. Now, some people say, well, immigrants don't buy houses. Illegal immigrants don't buy houses, and that's very true. Illegal immigrants don't buy houses, but they do rent, right? So if you take out the threshold of people renting, that means that now that the vacancy rates go up. So if vacancy rates go up, now you can't cash flow, in which case those people who are renting as landlords, they say, well, I can't find someone to rent this house. I'm going to put it on the market to sell. And so once again, that boosts inventory, right? So all of that inventory is coming around the same exact time. And so I think because of this, we're looking at a period of maybe 5 to even 10 years where you're going to see homes underperform their natural growth rate of about 3% per year. And that's going to anchor shelter inflation, I think, for the next 5 to 10 years while everything kind of gets digested, right? Eventually, median incomes will rise higher and higher. And if you have this deluge of inventory coming online and population growth is not expanding as much, it's going to be a little bit more balanced. So in that regard, I think we've got a challenge that eventually things will return to the equilibrium, right? So even if rates do get cut, I don't think that there's nearly as much appetite among buyers to go out and buy homes, because it's like, yeah, you've lowered interest rates by 1 or 2%, but you're still trying to sell me this $800,000 house that was $400,000 3 years ago. Like a lot of these guys, they bought, like, dude, I still remember I'm looking at some of the prices in my area of $600,000 home. Some people have listed right now with no improvements for like $850,000. I'm like, in what world do you think that that's even remotely possible that you're going to get a buyer? And so a lot of the realtors that I've spoken to, they're like, look, sellers are delusional with the prices that they're trying to get right now. So either they're going to keep their home or they're going to eventually sell with much bigger discounts. And those discounts and that decline in price will eventually bleed into the data in shelter costs. And I think that's going to help the Trump administration, because then they could say, look, we were right. Inflation is down across the board, in which case it makes sense to lower interest rates even more. And as you lower interest rates, there's going to be a lot of people that have been chilling in their house because it's like, hey, I have a 3% or mortgage. I want to either go up or I want to go down in in this house, like want to buy a bigger or a smaller or downsize to a smaller house, that inventory is going to start hitting as well, because they're going to say, well, now my 3% mortgage home, if I have to pay 4% or 5%, I can afford that difference. Whereas right now at 7%, the difference is just too big for them to sell their 3% house to get a 7% house. Does that make sense? Right? So, like I said, there's like a confluence of things, but I think the general tone that I have is inflation is coming down. Housing costs are coming down. So, yay for everyone looking that. So, do you have any opinions on that, Maddie?
I'm interested to see what happens, because I have, unfortunately, I was expecting to move a lot more with being in oil and gas. And once I found out that I probably was not, and I was starting to get into my 30s, I wanted to kind of really kick off my real estate portfolio. And so once that kind of train started, I kept just buying more and more property. And unfortunately, it was after interest rates had already started to rise. And so all my properties are around 7% or higher in terms of interest rates. Luckily for me, my personal house, it's just me, so it's not a big deal. But I would like to refinance my personal home, and all the other homes that I have are cash flowing. So, but it would be nice to be able to refinance those homes, and get a little bit better in terms of the free cash directly to the bottom line, because obviously the current cash flow goes, or a decent amount of that cash flow goes directly to interest payments at the moment. So it would be nice, and in the order of several $1,000s a month, or sorry, $7,000 a year goes to interest. So it's an interesting piece where I'm curious to see what ends up happening. Some of the properties right now would be freed up by $4,000 or $5,000 easily a year in interest payments, or maybe not interest payments in total, but lowered payments. And so in that respect, I could use that capital to put back into the properties, or save up that capital for buying additional properties, if that makes sense, or just paying myself. But also, at what time do you do it, right? Do you wait? If we're going to be in a continued interest rate cutting environment, it's almost like a timing thing. And especially if we're going to be entering some sort of recession as well, you kind of have to play the ball as well, because if you end up in a situation where they don't value your property, then they might actually be like, no, actually you don't have that 20% equity that you once thought you had, right? You might only have 15, 10%. So you can't refinance the property, right? So it's almost like a game to be had here, where you want to refinance the properties right now that I've purchased on paper right now look like they've gone up. So if we were to get them evaluated right now, we probably potentially see the fact that they've potentially gone up on paper. And we'd probably be able to eliminate some interest payment on some of them. But if we wait too long, like you stated, and things continue the way that they have been going, obviously the only way to kickstart sales again is to lower prices on homes. So it's interesting. For the places that I'm looking at, though, in New Jersey, a lot of the value of those homes, it doesn't look like have been getting cut too much. But here in Houston, it has been getting hit pretty severely. So it's interesting. There's select parts of the country that have yet to get hit as hard. So I'm curious to see if the select areas where there's a lot of demand still.
I think Matt's internet just went out. Hey, Matt. All right, boys and girls, I think that is all for us.
Really weird. I don't know why that happened. Can you hear me?
Yeah, I can hear you. I can hear you.
Yeah, it's just like it just ended. But yeah, so yeah, I'm sure select areas that was really strange. It just like all of a sudden No kick.
Yeah. I think areas that saw the biggest building booms are the ones that you have to worry about, like especially in the Sun Belt. I think the other parts of the country, they just like the Northeast, they don't build a lot of homes up there, especially during COVID. They did not build a lot. So the inventory over there will get absorbed pretty evenly. So you're not going to see a major downward move in the North. The one thing that you do run into in the North is that you will have a huge amount of inventory unlock from a lot of people looking to move down south to warmer weathers, right? So, the natural flow has always been populations, people live in the Northeast. They eventually move down to the south or the deep south when they're retired, Florida's the world, whatever. And then they sell their homes in Long Island or New Jersey. And so that inventory should kind of pick up. But once again, there's just not a lot of building up in the north. So that should help keep prices somewhat stable. Texas, Florida, Georgia, Tennessee, Louisiana, Mississippi, all of these areas you're going to see. And I think especially Florida, like, dude, I've seen some price cuts in Florida, but the cost of like buying a home in Florida is insane when you factor in the home insurance costs. Like home insurance costs over there are just insane because that's like another damn mortgage payment on some of these houses, So yeah, it's just everyone's got to keep that in mind. So, yep. Houses are not coming down to Silicon Valley. Can't see that happening unless massive economic negative. See, the challenge with Silicon Valley is that if you really get a lot of uptick in AI and you see a lot of layoffs in tech, you're going to see some problems happen to Silicon Valley too. It's just a matter of regional strengths and weaknesses that eventually could play out. But we could talk about this more. Let's kind of end it. It's been an hour and a half.
Absolutely. Yeah. So please, everybody, if you have the opportunity, please check out Webull. We have the opportunity to potentially get 3-4% on switching up with that. So you can find that link in the description. We'll tell you guys more as we find out more, potentially get the affiliate link associated with that. Chris's Patreon, if you want to join his Discord, is also in the description down below. Somebody on Twitter was asking if we do this show other than Twitter. Yes, we do this on YouTube. So if you want to participate in the chat, unfortunately, Twitter doesn't really have a very good chat feature. So if you want to join us over here on YouTube, please go ahead and do that. My Patreon is also in for donations in the description as well. You could also follow me on Twitch if you're interested in watching me on Rocket Lab Weekly. And then also in the description as well, we have Chris's X as well as my X if you guys have yet to follow us. And thank you guys so much. Over 300 people on our first return episode on YouTube watching pretty much for the entirety of the time. So that was a lot of fun and appreciate it's been a nice break, but overall, nice to be back. And let us know if you guys have any comments about what you guys want to hear from us this season. I know some people are asking about what our returns look like. We'll get to that. Things are looking still healthy comparatively to the S&P for year to date. I didn't check the 1 year, but I assume still very healthy comparatively to the 1 year. Still outpacing the S&P by a pretty healthy margin. For the year to date, I think it was like 33% year to date, comparatively like 13% for the S&P. So still looking good for the YouTube portfolio. So we'll talk a little bit more about that going forward. And Chris Patel, anything else other than we'll see you next time?
No, that's about it, man. I think you covered it. We are going to probably do some tutorials on things that this year that we might have not done as much in the past. Like take a look at this. This is something that I've been using on Webull that helps me kind of figure out entry points into certain names that I really like. So like right now, this is a chart for Norwegian Cruise Lines. There's some really cool features on here that I've been utilizing. And so I think this would be a good thing to just show people like, hey, you know what, this is what a golden cross, this is what a death cross looks like. This is what a golden cross looks like. This is what you can use like MACD, RSI, all of these little technical indicators that I think from an investing standpoint, we always kind of do a lot of good work on fundamentals. But I think this time we can kind of show a little bit of what is it called? Technical as well. I don't know if, how do you feel about that?
I'm not really a technicals guy, to be honest with you. So
Yeah.
but
Yep.
I'm sure there's some people out there that really love the technicals piece. So
Yeah.
anything associated with it, I'm sure it'll be great to add to the piece. I do want to clarify something. There's a lot of people that have been asking, do we buy options? Do we do this? Do they at? There was a lot of people that asked me about this in Miami as well. Like, Matt, why are you an idiot? And why don't you buy leaps instead of I know that you like to buy, equity positions in a lot of your holdings. And to be very honest with you guys, and I want to end on this, just because you do something and I do something a different way doesn't necessarily mean you're right, I'm wrong, or that you're wrong and I'm right. To me, the way I look at these things specifically is when I buy a position in something, I generally don't plan on selling it. Like with NextDecade, I know it's going to take a long time to pan out. So I don't want to limit myself to 2027 or 2028. I think it's going to take some time to really realize the potential. So when you're talking about options, you have to be right, not only with respect to the movement of time, but also the timing, the value of what the opportunity is, as well as the timing of the movement, right? And so buying equity positions sometimes allows you to kind of eliminate some of that, right? You can sit and not necessarily have to be right on the timing. You can wait 6 months, a year, not necessarily be penalized. I had a guy tell me, is it's like, Matt, you're an idiot. If you think Amazon's going to 10 trillion, why don't you just buy leaps and 10x your money and then sell it? And I'm like, well, that means that if you find a 10x or whatever, and then you sell it, that means you have to end up finding another 10x. And what's the guarantee that you're going to find another 10x, right? If I think Amazon's going to be a $10 trillion company, why would I ever want to sell it? And that's the mentality I kind of have. It's not to say that it's right or wrong, but I see a lot of people trying to rush their way into success. But I think in all reality, some of these companies are phenomenal, and I don't ever plan on selling a lot of them. Like Rocket Lab, Palantir, NextDecade, I don't plan on selling some of these things for quite some time. So in that respect, why would I limit myself to owning them until 2027 if I can own them for potentially out to 2040 or beyond? So that's the way I have a view of some of these things. Now, it's not to say that that's right or wrong, and not to say that you buying a leap for 2027 is right or wrong. But that's the way I look at it. And so I don't want you potentially to limit your potential associated with that just because you're, I guess, super hot on leaps right now because you saw a video on YouTube and you think that that's the right thing to do. Unfortunately, sometimes we think we're smarter than we really are. So just keep that sort of thing in mind. Chris, I don't know if you have an opinion on that.
No, you're absolutely right. This is one of those it's one of those things that just over time you're going to find your own investing strategies and styles that work for you. For me, I'm a little bit more tactical than Matt is, and it's worked out really well for him, and it's worked out really well for me, right? So Matt, when he buys something, he's a strong believer, and he stays in the position for a long time, regardless of the valuation. For me, I'm like, oh, look, this is undervalued. Buy. Oh, look, it's overvalued. Maybe I'm going to reduce my position. Matt's like, no, screw that. My valuation time horizon is 5 years, not the next 2 years. And so in that regard, Matt can actually get the Palantirs of the world, the Rocket Labs of the world. For me, I get like, oh my God, UNH is oversold. Jump into the options position and do really well, or get into the Carnival Cruise position and do really well. And so each one of us has developed our own core strategies on how we're playing this market. Now, the great thing is both of us have returned exceptional returns for ourselves as well as people that follow us. So, I think that's the key, right? So each person has different ways that they're investing. And the thing is, you have to find out what works for you. You can't use what we do. You can't use what, Amit does. Everyone has to find their own style. And, and over time, you're going to learn what works, what keeps you sane, what gives you sleep at night. And if it works out for you, it works out for you. And if it doesn't, then find YouTubers whose strategy does work for you, right? And that's the benefit of having this community like the way it is. If we're saying some shit that's not working for you and it doesn't make sense, by all means, just find your spirit animal that does do it for you. So
Cool.
Yeah.
Thanks, Tom, for watching, and hope you guys get some good entertainment. We're looking forward to season 3. We'll see you next time.
see you later.
Cheers.